Good afternoon, everybody. Welcome to Wise Tech for Wise Money. I'm Gary Wayne, founder of A1 Solutions, where we help businesses grow through better strategies, smarter use of technology, and stronger market positioning. The title of today's episode is Rethinking Institutional Cash, Liquidity Risk, and Modern Alternatives. Today, I'm joined by Mayank Mohan, founder and chief investment officer of Museum Mile Funds, a firm focused on improving how institutions manage cash, liquidity, and short-term financing. Mayam, welcome to the show. It's really good to have you here. I wonder if you could tell our viewers a little bit about your career, how you started, and how you got to be at the fund.
Sure. Hey, Gary, thank you so much for having me. Yeah, happy to share that. So, I've been in the industry around 20 years, most of which were spent at some of the larger banks. So, I started my career at Merrill Lynch and then was there through the merger with Bank of America. And then I moved to UBS, which is a Swiss bank, and then MUFG, which is a Japanese bank. And across all these banks, I was generally within the space of equity derivatives trading. And over the years, my focus moved more to the financing side of the business. And then I moved actually to the asset management side and worked at a very large asset manager and hedge fund. And that is where I realized that there's a huge gap in terms of accessibility and know-how and focus really between asset management and banks in terms of access to some of these concepts and strategies that I essentially made a career of working on the banking side. And so the same strategies could be used to enhance yields on cash and margin assets on the asset manager side, but weren't quite being looked at as much as they could. Because asset managers, I think rightfully so, were and are generally focused on their core strategies, targeting those 20-30% returns, and they simply don't have the bandwidth to chase down the last 50 basis points or 1% or sometimes 5% of financing efficiencies. And so when I noticed that, I spent the next couple of years just researching that use case more, talking to a lot of people in the industry, and the more I dug into this, the more convinced I became that it was a real gap in what is an otherwise, I think, a largely efficient market. And so finally, a little over a year ago, I decided to launch our firm. And what we aim to provide is something very simple, which is maximum efficiencies on cash and margin assets, but yet something that has been somewhat underserved over the years.
Great CV, great history,
Thank
obviously
you.
a high flyer.
Uh,
For,
that's very kind of you to say that.
well, I mean, the pedigree of the banks you mentioned are second to none. And I think a lot of people would be happy to have one on their CV. So,
I've
obviously,
been fortunate to work at some really good institutions. Was able to learn quite a bit
where
while
you get
there.
the education, right?
Where exactly I had the education, yes.
So, you touched on what Museum Mile Funds does. Could you elaborate a little bit more, go into a little bit more detail on
Yeah,
what
yeah.
differentiates you from the other funds out there?
Yes, absolutely. And firstly, we don't deal in museums. I do get asked that from time to time. So the nomenclature comes from
What made the name? How did you get the name?
yeah, so it comes from a stretch of Fifth Avenue in the island of Manhattan, where you've got a bunch of museums, including the Metropolitan Museum and Guggenheim, and that's where we started. So that's where the name comes from. Museum Mile is what that stretch is called.
Fantastic.
But what we do is, so we provide access to cash and margin management strategies that very consistently outperform those traditional cash equivalents like treasury bills or money market funds or bank deposits or CDs, CPs, all of those, and very consistently so, while maintaining a similar risk profile, and in certain cases, what our clients believe is an even better risk profile. So higher returns, at least an equivalent risk, and then while also preserving the hallmarks of a good cash management strategy, which is just very high daily liquidity, short duration, ultra low costs, and then layered on top of all of that, for a lot of our investors, there are also tax efficiencies in addition. So, our offering is somewhat unique because, compared to any other cash management strategy out there, we do not, in order to get that yield enhancement, we do not compromise on credit risk, duration, or liquidity. And typically, to get that yield boost, one needs to compromise on one or more of those factors. So that's what we do.
I think I think it's quite a unique service you're offering because I've been around quite a few years and I've not come across so much of this type of strategy as opposed to portfolios and equity plays and bond plays, etc.
Well, that's what we got very convinced about, about just the unique niche in which we are operating, which kind of motivated me to start the firm in the first place. And thankfully, that feeling has been validated by the initial success, at least that we've gotten from the client inflows.
Can I ask what sort of returns you're showing?
So, our strategies typically they're showing around 1% of average outperformance over treasury bills. Again, very consistently outperforming treasury. So our S&P futures basis strategy, which has been acknowledged as the highest yielding cash alternative, that has outperformed treasury bills every month of its existence over the last 18 months that we've been running it live. And on an average, it's been outperforming treasury bills by 1%.
It's amazing. Well, from your perspective, what is the single biggest misunderstanding institutions still have about cash and liquidity today?
Yeah, so this actually, a gentleman that I ran into at a conference on the West Coast recently. I think he's part of a pension plan and managing cash there, amongst other things. And when I offered this to him, you know, I believe it was a misunderstanding, but he felt that only cash can be liquid, and so the assets, the strategies that we run, basically S&P futures basis, this stuff trades around $400 billion a day. There are institutions running tens of billions, if not 100 billion of it, even as we speak. And so there are other strategies that are highly liquid, and not just liquid in normal times, but liquid across crises like the global financial crisis, the flash crash, more recently COVID. So there are assets out there that consistently outperform cash and have that liquidity as well. And so that's sometimes not particularly well understood.
When you look ahead, what one change in institutional cash management will matter most over the next few years, in your view?
I think the one change over the next few years I envisage would be, just a move to some of these more sophisticated derivatives-based strategies, the likes of which, we are of course offering, the likes of which have also kind of become a little more popular on the retail side. For example, the box spread has been talked about quite a bit, and has been become somewhat popular. I think some of the same concepts will catch on, and especially the ones that can be dealt in institutional size. So I think we will see at least some, or at least the most sophisticated players moving away from the traditional, money market funds, bank deposits. There was, in fact, a recent article in the Wall Street Journal just talking about the inflation in money market fund fees. I mean, there are money market funds charging almost 1%, and all they put the money in is a bunch of treasuries or other bonds. And so I think the amount of returns that some of those traditional instruments are offering is not commensurate with the fees they are charging. And so I think there's growing adoption of these alternative strategies that actually, in many cases, have an even better risk profile while providing higher returns very consistently.
What pressures are really forcing change at the moment? Rates, regulation, operational complexity. I mean, what do you see is the main moving component in the market?
I think it's competition, honestly. In terms of what we do and what we offer as an alternative, it's really, our products are immune to changes in rates and regimes and, market dynamics and macroeconomics. It's really just a very consistent outperformance over those alternatives. And so if you're an asset manager or a money manager or a corporate treasurer, who's looking to eke out the maximum amount of return for a certain given level of risk, which I think is generally, economically the space in which most people would want to operate, then these are the kind of strategies that one should be at least evaluating. And so I think it's competition and, the and not all institutions are like that. Certain institutions just don't care about that last 1%. But the ones that are more sophisticated and where the decision makers are incentivized to maximize returns for a given level of risk are the earliest adopters. And then once they adopt, I believe then there will be others that will follow.
How easy is it to raise funds for a cash type fund? I mean, there's a lot of obviously funds out there in derivatives, all the fancy products, ETFs, whatever, options, and then we come to talk about cash, and it doesn't sound so sexy.
It does.
In reality, it's showing better returns. So, how easy or difficult is it to get that message across?
I think if there's one surprise, so to say, since launching my own firm, it's been the tremendous challenge of just distributing and getting investors on board. Because I frankly thought, and I've never been in a sales role before. I was always risk management, trading, so more execution side of things rather than distribution and client facing. And so, I always thought, it's an efficient market is like water, which just flows from high to low. And, you bring in a product in the market which, just maximizes returns for a given level of risk, and immediately capital will flow to it, as it should in theory in an efficient market. But, the big realization is that is certainly not so. I think that will be so in the longer run, and it is so, and that is why we've been able to attract the amount of capital we have. But it has taken a lot more effort than what I would have imagined. And so and I don't know if it's just about cash management. It's probably everything. I mean, anybody that I speak with will any other emerging manager or any even an established manager will only complain about the effort required to fundraise. And the thing is that somebody I was listening to another podcast, and they said that the world doesn't need another manager. And so there are already so many of us out there chasing those same pools
But
of
they always
capital.
need a good manager.
Exactly. So, We do believe that, yeah, there is a glut of managers, but the reason we started our firm is because we believe we have a truly differentiated offering, and that at least has been borne out in some of the initial results as well.
Digressing a little bit, obviously, with all the geopolitical issues we see in this world, how does liquidity work within the cash market? But we always say cash is king. And I know from experience that when there's a geopolitical problem or even a bad non-farm payroll, there's no liquidity in some of these markets. How do you find it in cash management?
Yeah, so that's absolutely paramount. So as I said, some of the core features of our offerings are just the lowest levels of risk, and then very high daily liquidity in all kinds of market environments. And then finally, it just the duration has to be extremely short. So whether rates go up or down, our strategies should be largely unaffected. So just we constrained ourselves into within the confines of those parameters to come up with these strategies. And so at least what we are looking at, are strategies that have stood the test of time, be it COVID or the flash crash or the financial crisis. And it's literally, in our S&P futures basis strategy, we're investing and we're trading S&P futures, which trades 400 billion a day. So, and we're trading the S&P index, which again, these are some of the deepest markets out there. So yeah, liquidity is very core to our offerings. Yeah, and for that reason, we are able to offer daily liquidity. So clients can come in and out any day they want to. There are no lockups, and yeah, we keep getting calls from clients who want to come in on a day, who want to get out, and we are always able to entertain those. So yeah, absolutely core to the considerations for a strategy to be considered on our platform.
But moving back a bit, after years inside major banks and asset managers, what patterns stood out to you the most?
What patterns did you say?
Within the trading and the investment, that they looked at that maybe, an elite money manager like you in this situation probably wouldn't bother with.
Yeah, so the one pattern, and in fact, this was borne out just this morning as well. This morning I was on the phone with a $1 billion asset manager, and again, these asset managers, and as I said, rightfully so, they are chasing those 20%, 30% returns, which are core to their offerings. And these guys are a quant shop. They've been doing this for, I think, the last 30 years or so and doing it really well. And they have their niche in the market. Very, very few are looking at with any amount of focus is that cash and margin management. And so as a result, even having done this so long, that isn't a focus of theirs. And again, rightfully so. I just don't think it makes economic sense for them to devote time to that stuff. And that's exactly where we come in. We kind of run accounts in separate. We run a separately managed account for our fund clients where we run our strategy, which is cross-margined with the core strategies of the fund, and so we provide that margin offset to their existing investments, increase the size of increase the capacity by removing any haircuts and so on. And so again, the going back to your question, Gary, the common thread that I found was just lack of attention to some of these optimization techniques that could easily be used.
Just before we move on, I've got a question. I used to trade futures years ago, and the S&P futures pit. I remember obviously, when it was actually, with guys in the pit trading. And then it
Yeah.
moved obviously to the electronic system. A lot of the locals all disappeared. They couldn't hack it on the electronic systems. It's quite sad stories for some of the big names. But how do you find liquidity and price action using the electronic system? You're probably too young to have traded in the futures bit, but
I
I just wondered how different it was trading a market like S&P, which always has been so liquid and aggressive
Right. Right.
via the electronic terminals.
So Gary, I am older than I might look, but I'll take the compliment anyway. Um, so I actually, at the start of my career, around 20 years ago, so while I wasn't in the pit and trading, but I was trading through the pit. So I was making calls and trading the large S&P future contracts, which were only pit traded, and then the E-minis
Yeah,
were traded electronically. And everybody on the desk was doing that. And so at some point I realized, hey, we've got these e-minis, and these are actually pretty good and very tight, and very liquid. And so at some point I switched. But yeah, in terms of liquidity in these markets, at this point, a lot of our trades are done electronically, but where we still, I mean, we don't necessarily go to the pit, but we do use execution brokers, right? So execution brokers have a couple of advantages at certain times. One is the fact that they are able to get upstairs liquidity. So they are able to get us access to these negotiated markets because they are talking to others like us. So that is one. Especially if we've got a chunky trade that we want to do, we would go consider, looking at the execution brokers. And then the second thing is more operationally so. There are many products where the tick size is actually smaller in the upstairs market. So, some of these contracts that we trade, they are 25 cents wide electronically, but if you go through the upstairs market, you could get something as tight as 5 cents. And so, again, may not be applicable and relevant in every situation, but there are situations that we would want to go away from the electronic market.
excellent. Where do even very capable firms still get liquidity decisions wrong?
Yeah, yeah, absolutely. Yeah.
I mean, where do you see some of the other firms getting liquidity decisions wrong?
So, I mean, uh, I
From
think,
your perspective, of course.
yeah, yeah, yeah. Liquidity decisions wrong. I mean, that would be more a case of investing in assets that without perhaps enough of diligence on their behavior during moments of stress. Looking at the longer term returns. The fact that it's publicly listed, but yet not perhaps doing adequate stress testing, and that is what can hurt at times. I mean, everybody, managers going around, everybody likes to say that their strategies are liquid, but if you really stress test that statement and look at, all right, how did it perform, the days that the market was down 10% or up 10%, and was there a market in those products? And that's the question to answer. And not every product out there can claim that level of liquidity, and so those could be decisions that can hurt during times of turmoil.
I know at the beginning you told us roughly what you do, but when you explain your firm to boards or investment committees, how do you actually describe them what you do?
Yeah, so we say that we provide cash and collateral management services, essentially, which are ancillary, and which are meant to be an add-on to their existing businesses. So what we do does not interfere with what they do. What we do is, we don't need and don't have visibility into their core businesses. but all we do is optimize their cash and collateral management, and we do so without subjecting them to any more risk than they might already be taking. So again, uh, consistently higher performance than their existing investments in treasury bills or money market funds. And again, consistently higher meaning, as we said, in our short 18-month live track record, we've outperformed every single month. Of course, one can do historical back testing, and there as well, one would see this consistent outperforming. We show some of those graphs which update on a daily basis on our website. So again, back to the message, it's consistent outperformance, similar or lower risk, very high daily liquidity, very low fee structure, and then there might be certain tax efficiencies just as a cherry on top. So that's really our core message.
How do you balance yield, liquidity, and discipline in real world portfolios?
Yeah, so uh,
Not easy.
yeah, not easy certainly, but the core assets that we invest in uh, generally come to our rescue there, because these assets we're talking about S&P futures. I mean, the at least in my experience, there's never been a liquidity problem with trading S&P futures, and again, these are the strategies that we run are not extremely actively traded. It's not as if these are not high frequency strategies that require us to be trading every day and intraday. These are generally uh, the amount of trading is fairly moderate, and so these are extremely deep and liquid markets, allowing us to adequately put on our hedges and carry the strategies as they need to be.
What does a strong, sorry, was you going to say something?
No,
What does a strong institutional cash strategy look like? I don't want to know your secrets. Can you give me an example?
sure. So, we offer a few different strategies, and again, these are, there have been papers written about them. I mean, including a paper by the Federal Reserve. So, for example, the box spread is one example, but we build upon the concept of the box spread. But the box spread itself, I mean, there's a paper by the Federal Reserve which calls the yield on box spreads as the actual risk-free yield, and that Treasury bills trade at a discount to the risk-free yield, and it calls the difference as the convenience yield, which exists simply because it's so much more convenient to buy Treasury bills rather than invest in these box yields. And so that's one example. Another is, as
If I
I've
can interject, just a lot of our listeners won't be familiar with a box spread. Obviously, people from the markets will, but someone who's learning about all this stuff and listening in, they won't understand it. So, could you just explain what that is?
Yeah, absolutely. So a box spread is a four-legged option spread strategy, which replicates a zero coupon bond. So while it is comprised of four different options, ultimately the payoff is a zero coupon bond, which, as we know, is essentially very, very low risk. So a zero coupon bond is an investment that pays off a certain known dollar amount at maturity. And so, because the dollar amount is known at maturity, before maturity, when you're buying that future cash flow, one would pay a discount to buy it. It's just like treasury bills. So that's what a box spread is. We could get into exactly what those four legs are, but one could Google that as well. But economically, that's what it is. It's a zero coupon bond. Of course, one has to ensure operationally that this is done right. One has to use, for example, only European style options, and so on. But those are operational mechanics. So yeah, I mean, there is this mechanism by which we can buy a bond equivalent using options. The great thing with that is that the yield implied by these box spreads is very consistently higher than, say, treasury bills or money market funds. And so um, you know, somebody invested in T-bills or money market funds might as well kind of look at these box spreads as an alternative investment.
Excellent. When institutions evaluate cash strategies, what do they tend to be overweight on, if at all?
Within cash, I mean, within cash, we see a lot of institutions just putting their cash in treasury bills. So
Right.
that I think is just the default. I mean, like the last I checked, there's $6.5 trillion of treasury bills outstanding, and yeah, so T bills. The general notion is that treasuries, U.S. treasuries, are the de facto risk-free rate. Of course, the interesting part is that the Fed thinks otherwise, and the Fed thinks that the box yield is the actual risk-free rate, and Treasuries trade a discount to it. So what we do is, in at least in the view of the Fed, we would be providing access to the actual risk-free rate.
What about what are they normally underweight?
Uh, I mean, just within their cash portfolio. Uh, I mean, within their cash portfolio, I mean, the normal cash equivalents that they use are just treasury bills, money market funds, bank deposits. I would say those are the three most common cash alternative investments that are currently used. And I think money market funds would, I mean, I think the top would probably be treasury bills and then bank deposits and probably then money market funds. That's my guess. I haven't quite done a full study and comparison. You know, yeah, I mean, in all of this stuff would probably be in the neighborhood of $10 trillion or something like that.
Numbers? Well, what does strong risk management look like in practice?
Uh, I I think um, it's important to be very precise about exactly what the risks are in a portfolio, what might be the market conditions in which they might materialize, and then what would be one's uh, go to, and what would be the plan of action if at all that happens. So it's, a lot of people talk about portfolios being very low risk. I mean, when I say that, we run a cash equivalent or a cash management strategy, I mean, I've had people telling me to, that they invest in FANG stocks as cash management, or more recently, I mean, we've heard of what crypto treasuries, or crypto treasury strategy. Again, I don't understand it particularly well, but yeah, I mean, I don't know what that means and how that works from a risk perspective, because
I'm not
yeah,
sure how they correlate, if I'm honest.
exactly. So yeah, I mean, it's one has to be. I think the world in which we operate, and the way we like to operate, is to be very precise in terms of exactly what risk factors we deal with our strategies, and what mitigants there might be, and what the plan of action might be if at all there is a risk event.
When building trust and scaling, obviously raising funds and moving forward, what gave early clients confidence in Museum Mile?
So I think just being very open and transparent about our offerings is something that we strive to do, and hopefully that enables us to build that trust. Just opening the kimono and showing things as they are. Getting deep into the details, and without necessarily quantifying risk factors, start by identifying what they might be. And then, of course, certain factors can be quantified, and we do that. Others could be a matter of judgment, and we point that out as well. But yeah, just being very true to what we are saying, and kind of using our ensuring that our words carry weight, and we don't like to kind of use terms without meaning them, or use them loosely. And I think, at least I hope that that is something that is appreciated by clients and enables us to build trust.
You find in your actual arena and your speciality, do you have a lot of huge competition?
So in exactly what we are doing and the way we are doing,
Yeah, that's what I
I,
meant.
I don't think so, actually. I don't think we do. Just so I talked about a client call this morning. Yesterday I had another one, and the ultimate conclusion from the client was that, hey, there have been times maybe people have tangentially mentioned some of these strategies and possibilities, but nobody has tried to commoditize and offer these as off-the-shelf investable products, which is what we're trying to do. And so, yeah, I mean, that, from all the conversations I've ever had and all the feedback I've gotten, I'm not aware of anybody else providing exactly what we are providing.
So if you carry on doing well, one of the larger funds might want to come and buy you.
Well, we'll see if that happens. I mean, as of now, we just we're working hard, trying to spread the word around, trying to just uh, offer ourselves as a resource to asset managers who may just want to educate themselves on what the possibilities are. And in fact, the call this morning was more educational in nature. Maybe it leads to something, maybe it doesn't, but I think that's kind of part of the process, and that's really what we are focused on, rather than necessarily trying to position ourselves as a target.
You said you've been going 18 months. Is it still traditional to build a 3-year track record before you actually launch a fund, or is it shorter time spans now?
I think the longer we go, the more traction we get. So I'll give a couple of different facets to answer that question. And firstly, I mean, I did get that a lot when I started, that, hey, show me a 3-year track record or show me your track record. And I said, look, that might be more relevant to somebody, to a stock picker or somebody who claims expertise in picking market direction. We don't claim any such expertise. The strategies that we offer are ones that yield more than treasury bills and other alternatives due to very well known economic reasons. And one can do a back test and see that that is true. And again, when entering into our strategies, the payoff is somewhat predictable. And so we would never enter and invest in these strategies unless we knew that the payoff was attractive. So it's a different paradigm of viewing things. And so really, because one can look at these strategies analytically, and one should, I think, look at them analytically rather than just looking at track record, Sharpe ratio, those traditional metrics. I think one should really look at all
And
right,
do,
what
do
is
those
the
traditional metrics still hold water?
They do. They certainly do. What I'm trying to say is that they may not be the most relevant for what we are doing. However, we're of course ready to provide those metrics, and because we were aware that there may be certain institutions who necessarily want to see a track record, so we started one. But yeah, and yeah, I mean, track records, those metrics, they are largely used. They're certainly used very widely. They're just not the most. I mean, we don't shy away from providing those, and they look great for us. We just think that potential investors should also look at us analytically rather than just looking at those factors.
In today's market, technology is obviously growing in value. How do you use technology in cash and margin management nowadays?
Yeah, so I mean, technology is obviously core to what we do as well. I personally have a technology background, so I'm an engineering undergrad. I worked in the tech industry for 7 years before going back to business school and then moving to the world of finance. Uh, Spent most of those 7 years at Intel, which was one of the biggest companies back then, and on the bleeding edge at the time. And I take a keen interest in seeing wherever we can gain additional operational or other efficiencies by using technology. How we use it right now, I mean, we use a lot of technology in just automation of processes. We use a lot of technology in data collection on a daily basis, data processing, reporting. All of that is highly automated and all possible through technology. And risk monitoring is the other part, right? Just making sure that we are on top of the risk of the portfolio. Uh, any upcoming trades that we need to do are almost or are mostly actually automatically generated. So yeah, I mean, certainly use technology wherever we can, and yeah, we've also kind of been using AI just in terms of the operational efficiencies, and so I personally do a bunch of vibe coding myself, and yeah, I mean, maintaining our centralized database, maintaining the reports and trade generation and all of that. So yeah, there's a bunch of automation that we've done and continue to get better at.
So do you have a dashboard where you can check everything on?
Yeah, absolutely, we do. Absolutely.
If you were rebuilding a treasury operation from scratch today, what would you design differently? This is obviously quite a good question, seeing that you have a tech background.
Yeah, so operationally, I think actually I'll answer that a little differently. I think a lot of treasuries perhaps don't have the right incentives. So in my experience, I mean, treasurers are, and a lot of treasuries are seen as a cost function. And so the incentives aren't really to, you know, eke out the optimal yields given a certain amount of risk. Rather, they're just, it's very prescriptive. There are policies that prescribe that, hey, this is what you can invest in and what you can't, rather than looking at the fundamental risks. And so that's the box that a lot of treasurers and treasury functions, the silo that they operate within. And I think that could be fundamentally different if one actually looks at it from a risk perspective and looks at and incentivizes them to go and actually make the most without taking on additional risk. And so that's been my experience. Of course, on the buy side, asset management side, that problem is less so. On the corporate treasury side, it's just the norm. And yeah, that's something that if I could, I would change. I just at this point I'm not in a position to, but hopefully when we are much bigger and the word gets out, then hopefully we force some of those changes.
Looking ahead, where do you see institutional cash management headed in the next 5 years, for example?
Yeah, so I think there are a lot of these kind of alternative strategies that are coming to the fore, and I do see the change. I do see institutions, especially within the financial services industry, and then even otherwise. Right? I mean, I've spoken with real estate firms that for whom who want to optimize yield on their management company cash. So there's nothing related to their core business, but rather just their corporate cash. The bonuses that they'll need to pay out at the end of the year and which accrue over the year. I've spoken with insurance companies, I've spoken with pension funds, and spoken with meaning, gotten tremendous interest from each of these kind of investors. And so, I think there is wide interest, and there is certainly the economic proposition is very compelling. And over time, I see more adoption of some of these more sophisticated strategies that were otherwise limited to basically the biggest and the biggest multi-strat firms. And I just see there being much greater adoption of those.
With the geopolitical volatility, we've seen a lot of people moving into gold and silver, copper, even commodities. Flight to quality, even moving out of crypto. Into these products, our traditional long-term so-called safe havens. How does that reflect on what you're trying to do? And is it pulling money away from funds like yourself into these commodity type funds just because of nervousness?
So that would be a choice of the asset manager. So what we don't advise on is the asset allocation decision. So all we say is that for your cash sleeve, we will optimize returns and maximize returns for minimal risk. What we don't say is that, hey, uh, put X% of your portfolio in cash. I mean, that asset allocation decision is totally up to the asset manager. And so, if they view gold or silver as an alternative to cash, then, that's their view and they're entitled to it. And that's fine. In practice, have I seen our business being impacted by people, moving from cash equivalents to gold or silver? Not really. I mean, I have heard. I mean, I've heard a couple of guys tell me that, hey, the U.S. dollar is going to collapse, and we are getting out of all dollar-denominated assets and all of that. So I've heard that. It's not I haven't. It's thankfully the people I've heard that from are not our clients. You know,
But the dollar collapsing, I've heard it all my life.
yeah. So uh, exactly. So it isn't the first time I'm hearing of that. The other part of it also is that even if you are non-dollar denominated, I mean, we can enhance yields in of the British pound, of Canadian dollars, because that's really a covered interest rate parity trade for us. So yeah, I mean, even if people move to other currencies, our offering will still enable them to get that higher yield.
So just is nearly all what you do dollar denominated, or do you do multi-currency strategies?
So as of now, all of our clients are USD denominated. However, we do have a couple of real prospects that are Canadian dollar denominated. I'm speaking with at least three prospects, one of whom might be pretty close to getting on our platform. And so yeah, we've had conversations with Canadian dollar denominated asset managers as well. At least one conversation with a pound, a British pound denominated asset manager. But yeah, as of now, all of our assets are USD.
Beyond the assets under management, what does success look like to you?
Success to me, I mean, it looks like just making any kind of change in the environment. Success looks like asset managers generally getting better educated and getting more efficient with what they're doing. That gives me a lot of satisfaction. Just the call this morning, being able to share what I've learned in the last 20 years with these guys. Yeah, I mean, that was extremely satisfying to me as well. So hopefully that the two are correlated, the growth in assets and the educational component. But yeah, either one is satisfying by itself as well.
I'd like to throw in a magic wand question here before we wrap up. If you could change one thing about how institutions around the world think about and manage cash, what would it be and why?
Yeah, so yeah, sorry, this might sound like a repeat, but I'll again go back to the incentive point that I had made. These cash managers are, they are just, you know, prescribed certain products to invest in, and not kind of think outside of that box. And I think that is inefficient, while obviously we don't want a cash manager to go, invest in some crazy strategy. So there have to be risk parameters that are prescribed, but it has to be the risk level that is prescribed. It could be, hey, you can do anything that is within the AAA realm, or you can go to you can go to triple B, or you can go to junk bonds or whatever. It could be that, it could be something else, but I think that is what I would want to change, because we do hear from time to, I mean, you see all these companies sitting on these massive pools of cash, and you go talk to them. I mean, we've been told more than once that, hey, yeah, what you're saying actually makes so much of sense, but you know what, my policy says I can only put money in treasury bills, in AAA rated bonds, and nothing else. I certainly cannot do, invest in your strategy, because the underlying products that you are in turn investing in do not subscribe to the allowed list in our policy. And I can go ask for a change in the policy, but to do so, I will need to go all the way up to the CFO of the company, who in turn will need to go to the board of directors. And frankly, in this whole conversation, nobody is really incentivized to go through all those hoops to get that extra 1%. So, so there you go. I mean, that's the agency problem that exists in so many institutions. I mean, perhaps not as much in some of the financial services institutions, simply because they are a little more educated. Not all of them, not the vast majority, but at least a few of them. But if to talk about Main Street, right? Then yeah, that agency problem is one that plagues them. So don't have all the solutions, but I think just some kind of incentive, aligning the incentives, and also prescribing risk rather than products themselves, would probably be beneficial.
Okay, before we close down, what advice would you give to founders building financial firms, obviously in complex regulated markets?
Yeah, so I don't know if I'm in a position to dispense advices yet, but one thing that I will share is that the regulatory aspect, of course, has been something that we've had to learn about along the way. I mean, especially going on my own now, rather than working at a larger firm where I had access to an army of lawyers and compliance personnel. The US in particular has this complicated dichotomy of regulations between the securities side and the future side. So that's kind of something that was early education for me. But generally, the regulations do make a lot of sense. So yeah, I mean, I would say either be the person that does all the work, and be the hands-on person, and that's what we mostly are. But apart from that, it also, I think, is a good idea to have at least one trusted advisor who is who is somebody that's more well versed with the legal and compliance side of things.
I mean, setting up a fund is no mean feat. I mean, it's quite a complicated, um, you know, setup. Any advice on how you'd go about that if you did it again?
Uh, I think it's somewhat early to tell. So yeah, I mean, in terms of what we could do better, I think, yeah, I'll probably be in a better position to answer that in maybe a year or two from now.
Okay, we'll do it on the next podcast.
All right. Look
Well,
forward to that.
man, I think that wraps us up. I want to thank you for attending. I hope you enjoyed it. Um, where can listeners learn more about the company and the fund and what you do, and how can they contact you?
So we have a website, museummilefunds.com. Uh, yeah, so it has all of the information that we talked about. It has some details on our strategies, a tear sheet. We also maintain a daily updating graph of where the implied yield of our strategy is. And you can see that, how it's historically performed and how it's compared to treasury bills, for example. And of course, all of our contact details are up there as well.
Fantastic. You're on LinkedIn as well?
Yes, I am on LinkedIn.
Okay, great. So, for everyone who's listening, I want to thank you for spending your time with us. I hope this episode was very insightful. We'll have another Wise Tech for Wise Money shortly. If you'd like to learn more about A1 Solutions, you can find me on LinkedIn or on my webpage as usual. Once again, I'd like to thank everybody for listening in, and I'd like to thank you, Mayan, for joining us. It's been a great, great podcast. I think the fact that it's lasted 56 minutes shows that. So thank you very much indeed.
Thank you, Gary. It didn't seem like 56 minutes. It's been a pleasure.